Hello everyone, welcome to the 47th episode of me learning how to trade in Forex. So in the last episode we went through what are you actually trading in Forex. We read through this page, we made notes, learnt about like the brokers, all that sort of stuff. Read through all this, we learnt that, well already knew that we're not actually buying whatever currencies we're dealing with, it's just a contract basically. Read through all this, CFDs for contract for differences, and yeah, we end up with trading Forex with CFDs. So let's get started. Trading Forex with CFDs. What is a CFD? CFD stands for contract for difference. Thumbs up. A CFD is a tradable financial instrument that mirrors the movement of the asset underlying it. It's a tradable So, CFD is a tradable financial instrument that mirrors the movements of the assets underlying it. Don't know what that is. A contract for difference is an agreement between a buyer and a seller to exchange the difference between the current price of an underlying asset and its price when the contract is closed. So, an agreement between a buyer and a seller to exchange the difference between the current price of the underlying asset and its price when the contract is closed. What a CFD allows you to do is speculate on the possibility of the price of an asset moving up or down, without having to own the actual asset. The logic behind trading CFDs is simple. If the price of an asset goes up by 5%, your CFD does the same. If on the other hand the price goes down by 5%, your CFD also loses 5% in value. CFDs enable you to bet on rising or falling prices without taking ownership of the underlying asset, and can be used to trade a range of markets such as Forex, shares, indices, commodities and crypto. For this lesson, we'll be focusing on Forex CFDs. Forex CFDs allow you to trade on the strength or weakness of one currency versus another. CFD trading is a buying and selling of contract for differences via an online provider who market themselves as CFD providers. When you open a CFD position and a CFD provider, it creates or issues a CFD between itself and you, so a more accurate name for a CFD provider would be a CFD creator or CFD issuer. Regulatory agencies actually use the term CFD issuer. Wait, so CFDs, providers and Forex brokers, they kinda do the same thing, don't they? When trading Forex, a CFD consists of an agreement, a contract, to exchange the difference in the price of a particular currency pair, between the time at which the contract is open and the time at which it is closed. When the contract is closed, you will receive the pay difference between the closing price and the opening price of the CFD. If the difference is positive, the CFD issuer pays you. If the difference is negative, you pay the CFD issuer. With CFDs, you can speculate on price movements either direction. Long and short in CFD trading are terms that refer to the position you take on a trade. You can open a long or short CFD position. So when opening a CFD, you will have the choice to either buy the CFD at the indicated ask price, sell the CFD at the indicated ask price. The choice you make here will reflect your view on the direction in which you anticipate the price of the underlying asset will move. This means that a long position means entering into a CFD contract with the expectation that the price of the underlying asset will increase in value. I bet the price will go up from here. A short position means entering a CFD contract with the expectation that the price of the underlying asset will decrease in value. I bet the price will go down from here. So a long position means entering the CFD contract with the expectation that the price of the underlying asset will rise in value, aka I bet the price will go up from here. A short position means entering the CFD contract with the expectation that the price of the underlying asset will fall in value. I bet the price will go down from here. In order to close the trade, you will do the opposite of the opening trade. So if you go long, then you sell. If you go short, then you buy. Going long, you buy, sell, 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 buy, buy. Let me just take a snip, copy that. It's been a long time since we have the diagram in. Jesus, how much is this? 49.99. So you'll be 49.99. Boom. In both cases, when you close your CFD position, your profit or loss is the difference between the closing price and the opening price of the CFD position. The extent of the profit or loss will represent this difference multiplied by the size, number of units of the position you traded, plus any fees and other costs such as interest charges on positions held overnight. As its name suggests, a CFD is a contract between two parties to exchange the difference in the price of an underlying asset between the time at which the contract is open and the time at which it is closed. If the asset rises in value, the buyer receives cash from the seller. If the asset falls in price, the seller pays cash to the buyer. For example, if you think GBP/JPY is going to fall in price, you would sell a CFD on GBP/JPY. You still exchange the difference in price between when your position is opened and when it's closed, but will earn profit if GBP/JPY drops in price and lose if JBP/JPY increases in price. CFDs are settled with cash, but the notional amount is never physically exchanged. The only cash that switches hands is the difference between the price of the underlying asset when the CFD is open and when the CFD is closed. The difference between the open and closing trade prices is cash settled in the denomination that your account is in. There is no delivery of physical assets. For example, when you close a CFD position involving Euro-USD, there are actually no euros or dollars physically exchanged. With CFDs, you are basically betting on whether the price of an underlying asset is going to rise or fall in its nature, comparing to the price when the CFD contract is opened. In the US, CFDs are banned, so US retail Forex brokers trade a product known as rolling spot FX contracts. From a technical standpoint, they're considered different from CFDs, but from a functional standpoint, they are the same. Both are cash-settled contracts in a particular currency pair that gives you exposure to changes in the price for that currency pair. When the contract is closed, you will receive or pay the difference between the closing price and the opening price of the contract. Both allow you to obtain an indirect exposure to the underlying asset currency pairs, which means that you will never actually own the underlying currency, but you may gain profit or suffer loss as a result of price movements in the underlying asset, as if you had actually owned it. CFDs are referred to as over-the-counter OTC derivatives because they are traded directly between two parties rather than on a central exchange. The two parties involved are you and your broker. Instead of buying or selling physical currencies, you are trading CFDs, which is a contract that enables you to speculate on whether the price of a currency pair will rise or fall. CFDs equals leveraged derivatives. We've already discussed how CFDs are financial products in the form of derivatives that enable retail traders to speculate on the changes in an asset's price without owning the asset itself. But another prominent feature of CFDs is that they are traded on a margin, which provides leverages. CFDs are leveraged derivatives. So, CFD are leveraged derivatives. Trading with leverage means that you can open a large position size without having to put up the full amount. Let's say you want to open a GBP USD position equivalent to a standard lot 100,000 units. Without leverage, you have to put the full cost up front. But with a leveraged product like a CFD, you might only have to put up 3% of the cost or less. This means that you can open a CFD position whilst only putting down a small percentage of the value of the total position size as a deposit, aka a margin. The amount of money required to open and maintain a leverage position is called the margin, and it represents a fraction of the position's total value or size. Yep, when trading CFDs there are two types of margin. The initial margin is the initial deposit required to open a position. The maintenance margin is the additional margin that's required if your position gets close to the incurring loss that the initial margin and any additional funds in your account won't be able to cover. If you fail to maintain the margin requirements of your trade, you will receive a margin call from the CFD provider asking you to deposit more funds to your accounts. If you don't, the position will be automatically closed and any losses incurred will be realized. This is known as trading on a margin. Yet we've gone through this margin trading. For example, a CFD contract with a leverage ratio of 50:1, which is a margin requirement of 2%, you would only have to deposit an initial margin of $200 to gain exposure to $10,000 worth of Euro USD. A leverage ratio is a ratio between the total notional CFD position value, that to which the retail trader is exposed, and the amount deposited by the retail trader, the initial margin requirements. You are effectively borrowing the other 98% of the value of the CFD. Profits or losses are based on the changes in the value of the total position size or notional value. This means that although you only pay a fraction of the total notional value of the CFD position, you are entitled to the same gains and losses as if you paid 100% of the total notional value. For example, if the total value of your initial position in the CFD trade is 10,000 and the leverage ratio offered by a firm is 100:1, the initial margin requirement for you would be set at 1% of 10,000, so you would need to deposit £100. A market movement of 0.5% against your position, originally valued at 10,000, would result in a 50% £50 loss against your deposited margin. The leveraged nature of CFDs means that the retail traders can be exposed to losses exceeding their deposited funds. Depending on the leverage used and the volatility of the underlying asset, the speed and volume of losses can be significant. We commonly see leverage ratios of up to 500:1 for Forex CFDs. With a leverage ratio of 500:1, a retail trader may open a CFD position worth 1 million with an initial deposit margin requirement of just $2,000. Such high leverage ratios make CFDs particularly price sensitive. In a fast-moving market, price can gap and losses can exceed the initial deposit. Candle 1 closed price gap, candle 2 open price. Many retail traders can and do go into negative account balance. This means that you can lose all your money and owe more money to your CFD provider. Leverage is what makes Forex trading appealing because it enables traders to open larger positions than what they can afford with their own money, which increases the potential for huge returns. New to margin trading and familiar with all this margin jargon, check out our lessons on margin in our Margin 101 course that breaks it all down nice and gently for you. All done nice and gently for you. Okay. New traders may wonder how it is possible for Forex traders to buy or sell currencies they don't own. They are also often confused by the concept of selling something before buying it. The key to the answers lies in the fact that the trader is trading a derivative, not the actual currency themselves. Because you and your Forex broker are exchanging agreements with each other, rather than the actual underlying assets, There is no need to own anything before selling. These derivatives are called contract for differences, or CFDs. A derivative is a financial instrument whose price is dependent upon or derived from the price fluctuations of underlying assets. A CFD is a contract under which two parties agree to exchange the difference in price between the opening price and closing price of the contract. When trading CFDs, you are effectively betting on whether the price of the underlying asset is going to rise or fall in the future, compared to the price when the CFD contract is opened. The more the asset's price moves in the direction you predicted, the more you'd profit, but the more it moves against you, the more you'd lose. You can open a CFD whilst only putting down a small percentage of the value of the trade. This is known as leverage trading or trading on margin. In the US, since CFDs are prohibited, retail Forex traders trade a slightly different product called rolling FX contracts or rolling spot FX contracts. But both products basically trade Forex the same way, tomato. In industry lingo, together they're known as retail FX CFD contracts. Forex brokers create these derivatives, CFDs, or rolling FX contracts for retail traders. Because retail traders can't access nor trade the spot FX markets, this is the only way that we're able to speculate on just the prices of currency pairs, or trade the Forex market. But if you're not trading in the spot FX market, where exactly are you trading then? Where are retail Forex traders actually trading? When trading Forex, where are you actually trading? In the previous lesson, you learned that retail Forex traders do not trade in the real FX markets. If that's the case, then where are you actually trading? When you click buy or sell on your Forex broker's trading platform, where do your orders go? That's what we reveal in this lesson. In order to understand where your trades go, we first need to understand where retail Forex brokers and traders like yourself fit within the FX market ecosystem. The FX market is fragmented and complex, but we'll try to provide a simplified and stylized overview. Let's pretend that there's a giant body of water, a gigantic lake. A lake that's bigger than an ocean. The gigantiest lake ever. A giant lake. Let's say that this giant lake represents the FX market. The giant lake is not empty, it contains boats. The boats come in different sizes. These boats represent the market participants in the FX market. Imagine there are thousands of these boats in the water. These market participants tend to be banks, non-bank financial institutions, multinational corporations, large institutional investors, algorithmic trading firms such as high-frequency tradings and electronic trading makers, hedge funds, and high-net-worth individuals. Some are huge, some are less huge. The huge boats are the large commercial banks like Barclays, Citigroup, Deutsche Bank, HSBC, JP Morgan Chase, and UBS. Their boats are huge since they have a lot of capital. The big boats sometimes trade directly with each other. This is known as a bilateral trade, so you can say that two boats can trade bilaterally. When these big boats trade bilaterally, only the two market participants involved know what the quotes given were and the actual price that was agreed on. Other market participants' boats do not have access to this information at all. Banks provide different quotes to different customers and agreed upon prices, and volumes are often never publicly disclosed. That makes it hard for any market participant to know if their trader was at a good or bad price. So you can see these two players are trading bilaterally with each other. So these two, you can see these are the bigger ones, these are the smaller ones. But there aren't only boats in this giant lake, there are a lot of islands. These islands represent different trading venues in the FX markets. The rise of electronic trading FX resulted in an explosion of trading platforms and electronic execution venues. These platforms are known as inter-dealer, single-dealer, multi-dealer platforms. However, with the rise of venues such as electronic communication networks, application programming interfaces, APIs, and API regulate aggregators, the distinction among those traditional segments have started to blur together and become less clear. Application programming interfaces, that's what, I didn't know that API stood for that, but yeah. In general, trading venues are where different market participants can come together and trade with each other. When trading on one of these islands' trading venues, market participants must abide by the island's rules. The islands run a marketplace that facilitates trades between market participants. Some even provide anonymous trading where you can submit orders without revealing your identity to the other traders. For example, if a buyer wants to buy 10 million units of USD JPY at 110 and the seller wants to sell 10 million units of USD JPY 110, the orders are matched up, all without revealing the identity of either buyer or seller. As you can see, there is not one single island where all trading takes place. And prices that traders buy and sell are unique to each island. For example, if a ship were to island hop, it might find on one island the ask price for the USD JPY is 110, whilst on another island the ask price is 110.1 or 0.01. The FX market is fragmented, meaning the USD JPY markets on one trading venue is separated from other trading venues. Each currency pair will have its own price. Liquidity and trading volume depend on the venue. Trading volume depending on the venue. FX trading occurs in many different places all at once. So there really isn't a single FX market. It's a bunch of different markets that comprise the FX markets. If you think about it, the FX market is really a network of a bunch of different places to trade rather than a single place. Trading venue, so the boats are trading at different trading venues. Islands differ in size. The size represents the amount of trading volume that occurs on the islands. Different boats trade on different islands. While some boats are rich enough to be able to trade on any island, most aren't. Depending on the island, only certain boats are allowed. For example, there are boats that are so rich that they actually own their very own islands. If a boat owns an island, no other large banks are allowed. Only special smaller boats, clients of the bank, are allowed. These types of islands are known as single dealer platforms. Example of single dealer platforms and its owners are Autobahn, Deutsche Bank, BarX, Barclays, Cortex, BNP Paribas, Neo, UBS, and Velocity City. BarX, Barclays, which is fine by most of the large boats since they also own their very own exclusive island anyway. This huge boat bank owns this island, so this one. Another example, the two big islands in the middle, only the biggest boats are allowed to trade there. The people who trade on these big boats are called dealers. So on these islands, dealers trade with each other in large quantities. The people who trade on these big boats are called dealers. This is known as the inter-dealer market. The prefix inter means between or among. The inter-dealer market is also known as the interbank market, since most dealers work for large multinational commercial banks that serve global clients. These huge banks are also known as bulge bracket banks. The islands in the inter-dealer market are known as the inter-dealer platforms, which are electronic trading platforms where non-disclosure anonymous trading occurs in the inter-dealer market. Example of inter-dealer platforms are EBS market and Refinitiv matching. The inter-dealer segment of the FX market is where the trades occur between FX dealers, as opposed to between dealers and their end customers, such as exporters and importers, asset managers, hedge funds, and even some retail forex brokers. In the past, only the biggest of boats were allowed on these big islands. This is because large boats preferred to only trade with other large boats. They deemed smaller boats as too risky to trade with. But nowadays, it's possible for medium-sized boats to trade there as well by attaching themselves to one of the large boats. We won't get into the details right now to keep things simple, but basically the large boat bank allows the medium boat hedge fund to trade in its name. This is how the medium boats are able to access these big islands and trade with the other large boats. In exchange for the privilege to trade in its name, the large boat typically charges the medium boat a fee based on the volume of trades done. This arrangement is known as prime brokerage arrangement, with the large boat in the role called a prime broker or PB and the medium boat in the role as a prime broker's clients. Prime brokers make it possible for these smaller but not too small market participants, despite their limited credit history or higher risk profile, to use the prime broker's higher credit rating and trade almost anywhere with anyone in the lake. Basically, the clear distinction that separate the interdealer market and the rest of the market in the past has now become blurred. The important thing to know about the interdealer market is that it is a global network of trading venues used by banks and large non-bank financial institutions to trade currencies between themselves. Trades occur electronically or via voice. This market operates in a highly decentralized fashion as a loose network where banks and NBFIs negotiate bilateral deals without central supervision. This supposed market is in reality a network. So when you see the term interdealer market or interbank market, it simply refers to a network where currency transactions are negotiated between financial institutions and other large companies. The rates that are traded in the interdealer market then spread like gossip to the other boats and smaller islands, the rest of the FX market, and are used as reference rates by other market participants. These rates are what's hopefully displayed to you by your retail forex broker, usually with a markup. Now that we're discussing retail forex brokers, let's see where they fit in the picture. A retail forex broker is one of the tiny boats. Of course, since some retail forex brokers are larger than others, their boats also come in different sizes. There are large retail forex brokers and there are smaller ones. Retail forex brokers can't trade directly with other boats. In order to trade, a retail forex broker needs to attach themselves to a larger boat and that will allow it to trade in its name. This special type of relationship is known as a prime broker relationship. The large boat becomes the retail forex broker's PB. A PB is an entity that is willing to represent the retail forex broker in all its trading transactions that occur in the lake and settle the trades in its name. But large boats are picky. For the larger retail forex brokers, they're able to enter into a prime broker relationship with a large boat. For the smaller brokers, they're considered too risky for the larger boats. They do not meet the rigid standards and are not able to secure a prime broker relationship, which prevents them from being able to trade with others in the FX market. Fortunately, there are special types of boats that have an existing prime broker relationship with a large boat and offer a service to these smaller brokers that allow them to piggyback off this relationship. This special type of medium-sized boat is known as a prime of prime or POP. Prime of prime refers to a firm that has an account with a prime broker that offers these services to other market participants such as forex brokers. POPs bridge the gap between the institutional and retail FX market by enabling retail forex brokers to leverage the POP's credit relationship with its prime brokers. PB? Prime broker, yeah. The POP allows a smaller retail forex broker to trade through it. Another way for smaller retail forex brokers to be able to trade with the big boys is to piggyback off a larger retail forex broker who has an existing PB relationship. So, if a retail forex broker is one of the tiny boats, more like rowboats and kayaks, where do you, the retail forex broker trader, fit in this picture? You don't. Huh? Aren't on a boat, you might ask? Nope. Just as you saw, it's already difficult enough for retail forex brokers themselves to get access to the FX markets. If other ships already deemed them too risky to trade with them directly without some sort of chaperone, PB or POP, why would they want to deal with an individual retail forex traders? So if I'm not a boat, what am I, you might then ask? A retail forex trader is not a boat. A retail forex trader is not a boat. Your retail forex broker is a boat, but you are in an aquarium on their boats. Retail forex traders do not trade in the market. Your broker creates his own market for you to trade in. You trade with and only with your forex broker. When you enter an order, it is your broker who takes it. An order is an instruction to buy or sell as placed by your by you via your account on your broker's trading platform. As a retail forex trader, when you enter an order to buy or sell a currency pair, the forex broker is the counterparty to this trade. This is true for every retail forex broker. You can confirm this reading the customer agreement document of any well-regulated broker. Your forex broker may provide you a trading environment that may look and feel like you're trading on the giant lake. Think of it as a simulation. Your broker imitates the real FX market so that it looks like the real market. For example, the prices it displays in a trading platform may be similar to what's shown in the real market, but in the end you're not trading with other traders. Your forex broker is your sole counterparty. It is taking the opposite side of all your trades. Your broker is the sole execution venue for the execution of all your orders. An execution venue is just a fancy word where orders are placed and executed. Because you only trade with a broker, it is a separate but parallel market. When you are trading, all you are doing is playing in your forex broker's internal market or aquarium. No money is leaving the broker. It is only when it needs to hedge trades that real money is used by the broker, but these hedging trades made by the broker, not you. This topic will be discussed more in a future lesson. Your trade never goes out into the market, nor do you trade with other traders, not even with other traders who use the same forex broker as you. For example, if you and another trader use the same broker, you both will never trade with each other. Both of you always only trade with the broker. You are not in the same aquarium with the other trader. You both are in separate aquariums on the same boat. Retail traders do not have access to the FX market. They only trade with their retail FX broker. In order to actually trade with the other FX traders, meaning you would be trading against the counterparty who is not your broker, you need to be an institutional FX trader. This is why we prefer to call the real FX market the institutional FX market. In the institutional market, retail forex brokers are referred to as retail aggregators. They're called this because retail forex brokers typically aggregate the net positions of their customers for hedging purposes. They then transact in the institutional FX market to manage their exposure to market risk. This will be discussed in more detail later. You should be wary of any retail forex broker that claims that you're able to directly trade in the interbank market or institutional FX market, or that they will do so on your behalf. Whilst your broker can participate in the institutional FX market, you cannot. You're stuck on your broker's boat and can only trade whatever your broker offers you. The electronic trading platform that your broker provides you is only connected to your forex broker. You are not accessing the FX markets. The trading platform is simply an electronic connection for accessing your broker. You are accessing the trading platform only to transact with your broker. Again, you are not directly trading with any other customers of the broker. Put simply, when you sell, the retail forex broker is the buyer. When you buy, the retail forex broker is the seller. The purpose of the retail forex brokers is to act as the market makers for retail traders. Because the wholesale institutional FX market is inaccessible to retail traders, the retail forex broker is literally making a market for you to speculate on currency exchange rates. It does this by providing you an online trading platform that shows you quotes on different currency pairs that you can buy or sell on. You are only able to open and close your positions with your broker. When you open a position, you actually enter into contract, which is a private agreement between two parties, you and your forex broker. These contracts are called contract for differences or rolling spot FX contracts. Contracts you enter with your broker can only be closed by your broker. This means that you will not be able to close position with another party. The quotes that your forex broker provides you may be informed by or even come directly from the institutional FX market via price feeds, but it is your broker who you are still trading against, nobody else. Why is this important to know? Since the broker is the one taking the opposite side of your trade, this creates a potential conflict of interest. How? If your trade makes money, your broker loses money, and if you lose money trading, your broker makes money on the trade, plus any other fees they may charge. So from your broker's perspective, it's in their interest if your trades lose money, which conflicts with your interest since you want your trades to make money. Notice how we mentioned a potential conflict of interest. Potential is used because there are ways to mitigate this conflict between you and the broker. This will be discussed in more detail in a later lesson, but what's important to know now is that the potential conflict of interest does exist. Counterparty risk in Forex trading. Because your broker is your sole counterparty, this means that there is a risk that it might not meet its obligations to you. This is known as counterparty risk. A counterparty is the other party that participates in the transaction, and every transaction must have a counterparty in order for the transaction to go through. The buyer and seller in transaction are also known as counterparties. The buyer is a counterparty to the seller is a counterparty to the buyer. A counterparty is the other party that participates in a transaction, and every transaction must have a counterparty in order for the transaction to occur. With regarding to trading, a counterparty is simply the other side of the trade. For example, a buyer is a counterparty to the seller. So, principal buyer, principal seller, counterparty, counterparty. You, the buyer, and the seller, the forex broker, are known as principals. A principal is a party involved in a contract. So as a buyer, you are a principal, and as a seller, the forex broker is also a principal. You trade as principal, and your broker trades as a principal. When you trade with each other, it is known as a principal-to-principal trading. This is why a forex broker is not really a forex broker, but a forex dealer. A broker is supposed to act as an agent on your behalf who simply brokers a deal between you and another counterparty, principal, or in other words, matching your order of a buyer and seller. So by definition, a forex broker cannot be a true broker since it is your counterparty, since it takes the other side of the transaction as principal. Counterparty risk, also known as default risk or counterparty credit risk, is the risk that a counterparty will not pay as obligated on a contract. For example, if two people agree on to trade and there is no one else to verify the trade, it is possible that one party could back out of the agreement or be unable to produce the funds to hold up their end of the transaction. If you open a position with your broker and then close it for profit, what happens if the broker doesn't have the money to pay out your winning trade? What if other traders open a similar position as you, where they also end up with a profit? The aggregate profit from all these trades results in the broker having such a huge loss that it goes bust and doesn't have the capital money to honour the winning trades. Since the position was a transaction between you and the broker and you can't move or transfer the position with another broker, you are screwed. Let's repeat that again for emphasis. When you win, your counterparty loses. If your counterparty, which is your broker, is unable or unwilling to fulfill its obligations upon losing a trade, you are screwed. Worried yet? Well, here's one more example for you. What if another customer using the same forex broker as you opens a massively huge position and price skyrockets in his favour, making him a ton of money? He bet right and huge and hit the jackpot. He makes so much money though that the broker doesn't have the money to pay him and goes bust. You have money deposited with the same broker which you think is safe, but in reality, if all of the broker's money is gone, then the money owed to this winning trader may come from your money. Unlike in an exchange traded market like stocks or futures, which has a clearing house that acts as an intermediary between the buyer and seller to make sure certain both parties honour their contract obligations, the FX market does not. This is because the FX market is an over-the-counter market. In an over-the-counter market, there is no third party available to step in and make sure you receive the money owned to you. Think of an OTC transaction like a face-to-face transaction. Such a transaction is arranged and prices are negotiated by two parties, buyer and seller. I would like to go long at market 2 lots of USD JPY. Just like a face-to-face transaction, there is no third party or escrow services as an added layer of protection for both parties. So if your broker goes out of business or can't honour your winning trade, your money is gone. At that point, your only course of action is to try and recover any funds. Is to file a complaint with the regulatory agency that oversees the jurisdiction where your broker is legally licensed to operate. Of course, this is assuming that the forex broker actually holds a license for your local regulators and is authorized to provide retail forex trading services in the first place. This is why knowing where your broker is licensed and regulated is super important. Now, just because it's possible for a retail forex broker to go bust doesn't mean it will. Depending on how a forex broker executes its customers' orders, there are ways to manage this risk. Let's learn how forex brokers manage risk. Okay, that's a lot to take in. So, as retail forex traders, we don't actually trade in the FX markets. So, how shall I explain this? I think this diagram is the best way to explain this, using the words Dave said actually. So, paste that in there. Let's see. Lake equals. This is the institutional FX market. Forex market. Big island in center equals interdealer market. Wait, let's just do individual islands. Islands equals different trading venues in the FX markets. Different trading in the FX market. Different market participants can come together and trade with each other. Boats equals market participants. Size of boats matter. Biggest of boats trade directly with each other. This is known as bilateral trading. What else? Interdealer markets. Island center. People who trade on these big boats are called dealers. Dealers trade with each other in large quantities, known as interdealer market. Interdealer market. This is the interbank market, let's call it. Retail Forex broker is one of the tiny boats. Retail broker is one of the small boats. Tiny boats, not smaller, tiny. Aquarium. Each retail FX broker has its own aquarium. Has separate aquariums for each retail trader. Each retail FX broker has separate aquariums for each retail trader to simulate the institutional FX market. Meaning retail only trade retail traders only trade against their broker. Trade against their broker. Your broker is your counterparty, as you're only trading against them. Okay, I think that makes sense. The lakes is institutional FX market, islands, different trading venues in the FX market. Different market participants can come together and trade with each other. There, boats equals market participants. Size of boats matter. Biggest of the boats trade directly with each other. This is known as bilateral trading. Retail FX brokers is one of the tiny boats. Big islands in center equals interbank market. Big islands in center equals interbank market. Only the biggest of boats trade there. Aquarium equals each retail FX broker separate aquariums for each retail trader to simulate the institutional FX market. Each retail FX broker separate aquariums for each retail trader to simulate the institutional FX market. Meaning retail traders only trade against their broker. Your broker is your only counterparty, as you're only trading against them. Yeah, that makes sense. Cool. I'm going to leave this episode here. There's a lot of new stuff learned in this episode. So thank you guys for watching, and I will see you guys in the next video, which is how Forex brokers manage their risk and make money. So, peace.